Hi Ben, Ash here. How much money would I need to invest to replace my wife's income so she doesn't need to return back to full-time work and perhaps only needs to return 2 or 3 days a week? Would love to understand, to generate an income of perhaps an extra $20 to $25,000 a year. Thanks so much, Ben.
Replacing your salary with investment income or your ideal salary or a part of your salary is, to me, the real definition of financial freedom. Because when you replace your salary with investment income, it means that you have the ability to work out of choice, not out of necessity. So, applying that to the context of having children, a common question that we get is exactly this: how do we replace a level of income so that we have then the flexibility for one or both partners to work at a reduced capacity? Now, the rough rule of thumb is that you should be able to draw 5% from a portfolio of assets without eating into capital. What that means in human words is that basically, if you have $1 million invested into a diversified investment portfolio, generally shares, and I'll talk a little bit more about that, but it should generate you an income of about $50,000 in the next 12 months. So 5% of $1 million, $50,000 in the next 12 months, and continue to generate that same level of income every year forever into the future, and have that actually inflation adjusted as well. Maybe not with the hyperinflation that we're seeing at the moment, but long-term inflation adjusted. Now, how we get there is that the 30-year return on the Australian share market is 9.8%. So if you take off from that 9.8%, you take off 1% for fees on your investments, 1.3% for taxes and incidentals. Again, it's a rough number, but it's a good starting point. And then 2.5% for long-term inflation. That brings it down to 5%, meaning that you get that 5% inflation adjusted long-term return. So if your target is to replace income of, say, $25,000 a year, you're going to need about $500,000 in an investment portfolio in order for you to replace that income moving forward. Now, what those investments would actually look like, generally you're looking at a diversified share portfolio, but it has to be one that pays dividends. And Australian shares are really good for that. Australian shares have the added advantage that dividends are typically paid with franking credits attached to them. And what that means is that tax is already being paid on the company profits. You think Commonwealth Bank earns $5 billion and then they pay a whole bunch of tax, then they pay out part of what's left over to their shareholders as dividends. You receive, as a shareholder, you receive a tax credit for the tax that's already being paid by Commonwealth Bank. So the ATO are kind enough not to tax you twice. And that means that the tax ends up being lower on the income that you receive. Again, it is a rough guideline, but it's a good starting point to get you thinking. And you can tie that back to one of the previous questions that we've had around goal calculators and investment calculators as to how you can actually get there in a time frame that you want. Bit of work to be done, but the results are definitely worth it.